You are going to learn today how I got a free commercial real estate property. And when I say free, I have no money, none of my own money tied into this deal, and I'm collecting cash flow from it every single month. The Infinite Return, Rich Dad Poor Dad, Robert Kiyosaki goes over how this financial metric can be achieved, and I'm gonna go over how I achieved it in this example in today's video. My name is Richard Rodriguez with Commercial Agent Academy, and if you're looking to learn how to invest, just to learn how to develop a skill set in commercial real estate, whether you're an investor or broker, you're at the right place. And I look forward to connecting even afterwards. Send me a message. And I'm going to be giving an example of how I was able to hit an infinite return on a commercial property that I purchased in Southern California. This is a commercial property. It's a warehouse, and I just want to go over the basic features of the deal here. So starting is that the purchase price was $350,000. I purchased this cash, okay? So there's no initial mortgage. The cost to close was about $3,500. That was my escrow title fees. So all in, I was in at about $353,500, okay? And I want to go over a couple things. So the rental income. So one thing to note, when I bought this property, there was already a tenant in there on a month-to-month lease paying well below market rents. I got them out of the property after I took possession. They needed a bigger space, so it was a pretty seamless transition. But when they delivered the property to me, this thing was in shambles. It was beat up. I needed a lot of capital expenditures. So you'll see that I did put some CapEx on year one. Okay, we'll go down the items right now. So total rent right now is $51,000 a year, which equates to about a little over $4,000 a month is what I have that leasing for. Okay, you will see some vacancy year one because it did take me about 4 months to secure a tenant. Okay, so that's what this $16,000, almost $17,000 in vacancy is. Okay, so you'll see here, you'll see the rental income, after the vacancy loss, and then also one thing you want to get to are the operating expenses. Operating expenses are a little higher than the other years at $15,000 because of broker fees that had to be paid. And you'll see here that they just go down. The other two expenses are really just property insurance and property taxes. Okay, so that leaves year one net operating income at about $18,000, and you'll see that $30,000 capital expenditures is what I was referring to. So this was a new roof, new paint, new office, mezzanine build out. So quite a bit of improvements on the property year one. Okay, so $30,000, and that takes year one to a negative. It's a loss of $11,000. Almost $12,000. Okay, and that's why the cash on cash is a negative on year one. Okay, and this is that cash on cash return on the initial $353,000. Okay, so let's take it to year two. All right, year two, things start to drastically change. Obviously, I don't have that vacancy. It's on a lease, 5-year term to a business. It's a commercial property. And we still have the expenses of the property insurance and taxes, which are going up about 1.5% per year. That's accounted for, as you can see here. And you get the net operating income of year two at $45,000. Okay, and that's the net operating income, and there's no debt service, so that's straight in my pocket, right? Straight in my pocket, and that cash on cash now goes up to 12.8%. I'm happy with that. I mean, I can't find a bank, I can't find a CD that's going to pay me 12.8 on my cash today. So this is very exciting for me. But where things really start to get interesting is year three. Year three, essentially the net operating income is the same. It goes up the 3%. The yearly rents go up about 3% is what this term is on the 5-year. But as you see, as we come down here after the net operating income, we do have a refinance. I refinanced the property year three, and you'll see the specs on the refi. It's about $402,000, which is about 50% of the property value based on the income approach at a 6 cap. Okay, this is a 7% interest rate, amortized over 25 years, doing 10 years, 2% loan cost. And my monthly payment is going to be $2,841, which starts to eat up against the cash flow, right? So the total debt service per year is $34,000 in year 3, and it will remain for the remainder of the term, as you see here. But I get this liquid cash of $393,000 and some change after loan costs and all that good stuff. So my cash flow before taxes in year 3 is give or take $407,000. Okay, why is this important? Why is this make me smile right now? Well, because my initial investment, guys, remember, it was $353,000. Right? I put in an additional $30,000. So let's call it 380. Let's just make it simple, $385,000. And I pulled out 406 in year 3. Okay, 406 in year 3, and you'll see that I do have that loan balance now of about $395,000. My cash on cash return is 115% in year 3, and I have none of my initial money in the deal anymore. So I am making money in year 4 and year 5. As you can see here, this is the net. This is my yearly income with none of my initial money in the deal anymore. And shout out to Robert Kiyosaki, Rich Dad Poor Dad. That is what I define as a infinite return. I'm making money on an asset that I have none of my initial money tied into it. So another key features, another key metrics to look at is this 27.7 IRR. It's the internal rate of return over the 5 years of this property. If I were to exit at year 6 with a purchase price of $857, which I mentioned, this value is based on the net operating income of the property in year 6 at a 6 cap. Okay, so how do you value a commercial real estate property? Net operating income divided by the cap rate, and in LA County, 6 cap, that's more than conservative. Cost of sale. So this would be my net proceeds after I already pulled out all this money year after year on this deal, and that's where you get this internal rate of return at 27.7. So this is the yield that I had with the investment of my money inside this deal over this 5 years. Okay, and yeah, so it's pretty exciting stuff. This is just an example of an infinite return, right? This shows you the net operating income, my cash flows as the years progress over the 5-year term. It's a pretty awesome analysis, cash on cash year 1 analysis. But the initial one is, in my opinion, the most important that I just explained to you guys. You see here that the cash on cash exponentially goes up in year 3 because of that refinance, right? That refinance. And mind you, I started at negative, right? Because of the capital expenditures that I had and the vacancy and the broker fees and all that good stuff, which is fine because I knew that there was a ton of upside going into the deal. So that being said, there's a lot of things going on here. I want you guys to comment any questions you may have, or any feedback on the deal here. And yeah, I look forward to sharing some more. But this was just purchased beginning of the year, so it's a very nice asset for the portfolio here. Nevertheless, see you guys soon.